Hello everyone. After opening lower against almost all currencies yesterday, the dollar bounced back during the day and is starting trading in Europe Tuesday slightly higher against most currencies than it was 24 hours ago. This comes despite a disappointing Empire State Manufacturing survey for September, which was somewhat offset after the U.S. industrial production for August came out in line with expectations. The main factor behind the rally, though, is that apparently many investors aren't so sure that Janet Yellen is going to get the Fed chairmanship by default. Some people believe former Bank of Israel Governor Stanley Fischer is now in the running for the Fed chairmanship as well. The 10-year Treasury yield had been down to 2.78% at one point, but finished the day in New York at 2.86%, while Fed funds futures that had been up 11 basis points at one point were 4 basis points off their peaks by the close, as the no summers rally faded. The dollar may be able to regain some of its losses further, but with Fed policy in flux, there are perhaps better ways to play the monetary divergence theme. Long Kiwi yen, long Aussie yen, short Aussie Kiwi, short Euro sterling, Euro Noki, or Euro Stocky. I think these are some ways to play policy divergence without involving the dollar. For example, the minutes from the Reserve Bank of Australia's recent policy board meeting, which were released overnight, only confirmed the policy divergence between Australia, which still reserves the right to ease further, and New Zealand, which has shifted to a tightening bias. The RBA members said they should neither, quote, close off the possibility, unquote, of further rate cuts, nor signal any imminent intention, which seems to me that they're retaining an easing bias. They also said that, quote, some further decline in the exchange rate would be helpful, unquote. On the other hand, New Zealand has definitely said that its next move on rates will be up. So see my article on the CNBC guest blog, Trading the Fed Taper, Avoid the Dollar. It's out today. Now, today's economic indicators include the September ZEW survey. Both the current situation index and the expectation index are expected to rise. That could prove positive for the euro, except of course that Germany is far from typical for the eurozone. In the UK, the EU harmonized CPI, which is the Bank of England's inflation target, is expected to slow slightly to a 2.7% year-on-year rise from 2.8% year-on-year in July. That'd be a victory for the bank and perhaps sterling positive as the pace of inflation slows for the second consecutive month towards their 2.5% target. In the US, both headline and core CPI for August are expected at plus 0.2% month-on-month, the same rise as in July and posing no problem for the Fed in its tapering plans. Finally, the National Association of Home Builders Index for September is forecast to fall slightly to 58 from 59. But given the incredibly sharp rise recently to the highest level since the end of 2005, a drop of a point or two wouldn't surprise or disappoint anyone. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.